Every investor thinks they're hunting for the next big trade. Raoul Pal believes we're already in it. He calls it the single biggest macro trade in history, a once-in-a-generation shift where debt, demographics, AI, and crypto all collide. And if you don't see it happening, you're not just missing upside, you're being quietly drained by the very system that's supposed to protect you. In his latest interview, Raoul lays out a bold thesis. Crypto isn't a niche market. It's the response to a broken financial system. The famous 4-year Bitcoin cycle, it was never about the halving. And the next decade, it won't look anything like the last. Because what's coming isn't just a new market phase. It's an economic singularity where AI and blockchain fuse to reshape how the world creates, measures, and stores value. But before we continue, if you want to stay ahead of these macro shifts, make sure you're subscribed to The Crypto Nutshell, our free 5-minute daily newsletter read by tens of thousands of investors who want sharp, actionable insights without the noise. Check out the first link in the description. All right, let's get back to the video. Raoul didn't stumble into crypto by accident. He spent decades in traditional macro, watching how central banks, debt, and demographics shape markets. And over time, he realized something uncomfortable. The old system is structurally incapable of dealing with the debt we've built up. Central banks aren't managing the problem. They're rolling it forward, using liquidity, balance sheets, and financial repression to keep the game alive. When Raoul put all the pieces together, debt, liquidity, adoption curves, tech performance, one thing stood out. There are only a couple of assets that truly outperform the silent debasement happening in the background, and crypto sits right at the top. Here's how he explains it.
So we get to like this 11% hurdle rate for our investing. And then I realized when I put all assets together and looked at them, since 2012, there are only 2 assets that really outperformed. Technology, because every day is more digital than yesterday, or tomorrow is more digital than today. And that was doing about 18% a year in returns. So yes, it was compounding wealth. The S&P and gold and all of these things were basically in line with debasement, i.e. you weren't getting richer by owning them. And then there was crypto. And crypto was the fastest adoption of any technology the world had ever seen prior to AI. It was growing at twice the speed the internet grew at, and it was producing 145% returns over the same period per year, including 3 80% drawdowns. Mm-hmm. And so, okay, if everything's driven by one macro factor, we have this urgent pressing need in a highly indebted economy for new rails to operate within, then you only have 2 bets, which is the technology and crypto. And when you divide the NASDAQ by Bitcoin, it's down 99.97%. So you have the single most powerful macro trade of all time that offsets the debasement, that is an adoption of a technology for the new internet. And so I'm like, well, this, if there's any time to be all in, this is it. And so I went from being a diversified investor in global macro currencies, interest rates, commodities, to being highly focused on technology and crypto, with crypto being the single most important bet of all time. Mm-hmm. And, you know, where we are today in that journey is we're a $4 trillion asset class. That's pretty good for a new asset class. But if we extrapolate the trend rate of network adoption, we get to $100 trillion within 8 years. So we're only 4% of the way there. This
only
is the
4%.
So it's the biggest macro trade of all time.
That's the heart of Raoul's view. Technology compounds at around 18% a year. Traditional assets like stocks and gold over time track the debasement. You're not actually getting richer, you're just standing still. Crypto, even after multiple brutal drawdowns, it's delivered outsized returns that blow almost everything else out of the water. And when he overlays network adoption on top of that, he gets a roadmap, a $4 trillion asset class today, with a credible path to $100 trillion within roughly 8 years if the adoption curve continues. In other words, we're not late, we're early, sitting at about 4% of the potential total value. For Raoul, that makes crypto the single most powerful macro trade ever created. It's a hedge against debasement, a bet on new internet rails, and an adoption curve that still hasn't gone mainstream. But to really understand why he's so convinced, you need to understand the engine driving all of this, the debasement trade. Debasement is one of those words that gets thrown around a lot on Twitter. Raoul actually breaks it down in a way that's simple and a bit disturbing. Most people don't feel debasement. Their bank balance is still the same number. Their salary still gets paid in dollars, euros, or yen. But quietly in the background, the purchasing power of that money is being eroded, not just by inflation, but by a coordinated decision to keep printing, rolling, and refinancing the global debt pile. So, what do you do if the game is rigged that way? Raoul calls this the debasement trade, and here's how he explains it.
The debasement trade. We talked about we're creating excess money to service the debt. That comes with a cost. What is that cost? It's like people don't really see it. They don't feel it. You don't know what it is. What it is you are lowering the purchasing power of fiat versus scarce assets. So $1 today buys you, well, $1 million today buys you less of the S&P 500 every year because the debasement of the fiat currency. Real estate, gold, crypto, art, classic cars, anything that is scarce value holds value. This is exactly the same that happened for the Venezuelan stock market. In Bolivar terms, it was up 1,000,000% or whatever stupid number it was. When you look at it in dollar terms, it was down 99%. Why? Because they debased the currency to zero. And so that's currency debasement. It's happening about 8% a year on a globalized level because all the major central banks and governments are doing this. So the debasement trade is, if this is the most powerful macro factor of all time, what are the things that offset it? Now, Wall Street is very slow on the uptake, so their first thing is gold. But measurably over time, gold has not meaningfully outperformed debasement because its job is to actually just be stable money and have a stable store of value. So therefore, you're not getting richer owning gold, you're protecting yourself from the debasement. Fine. But if you're going to lock up money in long term by buying an asset, you need to get rewarded for locking your money up. So to be rewarded, you need an asset that outperforms that debasement. So Wall Street's finally caught on to this. It's something I've been writing about extensively, probably have done more research on this than anybody else in the world. And now finally Wall Street's starting to understand the game, which is that scarce assets outperform. Okay. Now they've all gone to gold, but gold, as I said, is a store of value, but is not a compounder of wealth. But why has gold been outperforming recently?
There are a few key points in that clip. Debasement is roughly 8% a year on a global level when you blend it across major central banks. Gold's job is to maintain value, not multiply it. It's a store of value, not a wealth compounding machine. If you're locking capital away for the long term, you don't just want protection. You want outperformance, an asset that beats debasement, not just survives it. Wall Street is finally waking up to this dynamic, starting with gold, but Raoul's been writing about it for years. And when you apply that lens to everything, the world looks very different. Cash is quietly bleeding. Bonds are structurally capped. Most equities are essentially just tickets on debasement plus productivity. Crypto and high-growth tech, in Raoul's view, sit where those forces intersect. They benefit from liquidity expansion. They're native to the digital economy, and they're driven by network effects, not just earnings and dividends. That leads us to one of his more controversial calls, the idea that the famous 4-year crypto cycle isn't really about halvings at all, and that this time, the cycle is longer. Ask most crypto natives why Bitcoin moves in cycles, and you'll hear the same answer. The halving. Every 4 years, Bitcoin's supply issuance gets cut in half. We get a supply shock, number go up, then we reset. Raoul thinks that story is clean, simple, and wrong. In his framework, the crypto cycle isn't driven by halvings. It's driven by debt maturity and refinancing, just like everything else. The same 4-year business cycle that drives equities, commodities, and broader macro, just expressed through a more volatile asset class. And crucially, he believes that structure has changed. Here's how he puts it.
The question is what drives the 4-year cycle? It was for a long while, people in crypto thought it was to do with the Bitcoin halving that happens every 4 years. And therefore there's a supply shock. But each year now, the supply shock is less each time. So it can't be the predominant driver. But then when you look at all assets, they're all driven by a 4-year cycle. And that was the cycle of the rolling or refinancing of the debts. So then if the structure of the debts is most important, what could have changed? Well, back in 2021 and 22, interest rates fell to zero again. So they extended the duration out by a year and got it to about 5 years. So if debt maturity and the refinancing of it is the dominant factor, then if they've moved out from 4 years to 5 years, the cycle should elongate. And that seems to be what is playing out by all the forward-looking indicators that we use. It says that the cycle doesn't finish until maybe this time next year. So that's a brave call, but it's a probabilistic analysis. And when people say, yeah, but the famous words of this time is different, I'm saying it's not different. It's just based on the debt. It always was. So if it's based on the debt, nothing's changed. The debt maturity has been extended to 5 years. End of story.
Is there anything about that cycle that we're in right now that has surprised you?
Yes, the business cycle hasn't picked up yet. And the business cycle is the strongest cyclical driver. So we've got the debasement, the printing of money, but really the business cycle has been subdued because interest rates have held high and other factors. So that is what surprised us. But this is really, it's a way of representing the elongated cycle. Normally the ISM would have picked straight up and we would be now with the ISM at, let's say, 57 or something, looking for the peak. But we're not. We're below 50. But the forward-looking indicators suggest that it still continues as normal. So what we've done is taken a business cycle that's this long and stretched it out a bit longer. And what we've seen is this year was that, the extra year in the middle.
So in Raoul's view, nothing mystical happened this cycle. We didn't suddenly break the pattern because of ETFs or halving fatigue or institutional sellers. Instead, debt got refinanced out further when rates went back to zero. That pushed the maturity profile of the system from roughly 4 years to around 5 years. The business cycle, measured by things like the ISM, has been unusually subdued, even with liquidity injections. The result? A stretched, elongated cycle where the middle year feels weird, not quite bare, not quite blow off top, just a long, grinding consolidation phase where people lose faith, narratives fragment, and everyone starts saying, maybe the cycle is over, maybe this time is different. Raoul's answer is, it isn't different. It's the same debt-driven macro structure, just slowed and stretched by the way we've extended maturities. And while that happens in the background, another force is building on top of it. AI. That's where his thesis gets a lot bigger than just crypto. Most people treat AI and crypto like two separate trades. Raoul doesn't. He sees them as two sides of the same transition. One changing who does the economic work, the other changing how value is stored, moved, and settled. The problem? Population growth is slowing or shrinking almost everywhere. Debt growth has already been pushed to its limits. So where does the extra oomph come from? Raoul's answer: AI, agents, and synthetic humans, all operating on blockchain rails. Here's the way he explains that future.
Trend rate of GDP is too slow. How do we pick it up? Well, productivity growth. That's probably going to come from AI and technology. Use of crypto rails makes the financial system much more efficient. We can capture more value. Debt growth, well, that's stopped, much like it had in the 1950s. So it's population growth. Well, if you look at all the forward-looking population, they're all shrinking. Every country is going to shrink its population. And that's, if we look at the births, deaths today, that tells you what the population is going to be in 20 years' time, or the working population. So we're fucked. But this time around, we have synthetic humans, which is AI and the robots. And not only the synthetic humans, we can create billions of them, and they're smarter than us and better than us. But how long does that take before it happens? Well, we're not there yet. People are using the technology, but it's not embedded in everything, but it will be. So my guess is somewhere by around 2030, 2032, we completely transition to this new world I call the economic singularity, where GDP growth goes weird because we've got infinite population growth. So that changes the whole formula. Productivity goes through the roof, but who captures it? Is it us as humans? Is it the machines? How does the system work? How does investing work when you've got AGI? I don't know any of these answers, but I know that they have to continue the debasement trade until that happens. until the trend rate of GDP picks up and they can lower debt to GDP. And so I think we've got until 2030, 2032 of this system operating. And what it's doing, it's causing a forced migration into the new system, which is blockchain. So we're by continuing to debase, the knowledge of what is happening is increasing. That is forcing the adoption of the new system. Because of how the new system works, the more people come onto the network, let's say Bitcoin, the more the number go up, the more people are rewarded by doing it, the more people move across. And that's the good thing to do as well. And I think the governments understand this. I mean, having spoken to the Department of Defense about this years ago, they're like, yeah, this makes total sense. Over time, we need to migrate people across, and then it gets rid of a lot of the fragilities of the economic system. So that's the trade. That's what's happening. It's a migration into a new world that's being forced by the debasement of currency that won't stop until the rise of the AI and the robots. And then after that, we have no fucking clue how it's going to work.
That's a wild picture. By around 2030 to 2032, Raoul expects we fully transition into what he calls an economic singularity, a world where synthetic populations of AI agents explode, productivity goes vertical, and GDP itself becomes hard to measure in the old way. Until that transition is complete, he believes governments have no choice but to keep debasing, continuing the same liquidity tricks just to keep the existing system glued together. And that debasement acts like a giant push factor, forcing capital and people to migrate onto new rails, blockchain-based systems where value is programmable, traceable, and native to the internet. That's the migration he's betting on, from fragile, opaque, off-chain systems to programmable, transparent, on-chain networks where value, identity, contracts, and AI agents all plug into the same base layer. In that world, Bitcoin isn't just digital gold. It's pristine collateral, the base layer. Smart contract platforms like Ethereum, Solana, and Sui aren't just coins. They're execution environments for value, coordination, and AI agents. Put simply, the more the old system debases, the more attractive the new system becomes. And because these are networks, the more people migrate, the stronger and more valuable the system gets. So where does all of this leave you as an investor? From this interview, Raoul's current worldview boils down to three big ideas. Crypto is the biggest macro trade of all time. Not a side bet, not a tiny sleeve, a structural response to debasement, technology adoption, and the need for new financial rails. The debasement trade is real, and it's accelerating. Fiat is losing purchasing power against scarce assets by design. Gold can protect you. Tech and crypto, if Raoul is right, can grow your wealth above that baseline. This cycle is longer, and it's part of a much bigger transition. The 4-year rhythm was never about halvings. It was about debt. With maturities extended to approximately 5 years and AI on the horizon, we're in the middle of a stretched business cycle that's forcing a migration from old rails to new ones. Whether you agree with Raoul or not, his message is simple. You can't sit in cash and hope. You can't ignore liquidity and pretend it's just noise. And you can't treat crypto like a casino sideshow while the largest macro trade of your lifetime unfolds right in front of you. The question isn't, is crypto risky? The question is, what happens to your portfolio if Raoul is even half right about debasement, AI, and this migration to blockchain rails? Because if he is, then staying underexposed might be the biggest risk of all. If you enjoyed this breakdown, consider subscribing to the channel. It helps us grow, and you can always change your mind later. See you all in the next one.